This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore.
Another good interview this week. I think you'd agree.
Yeah, it was great.
So we had Allison Schrager on today, and she spent her career thinking and studying and communicating about risk.
Not just risk in general, and she wrote a book called An Economist Walks into a Brothel, which is a great read, where she went and studied risk in places you wouldn't normally look for it, like in sex work, in surfing. What else did she have in there? Paparazzi.
Oh yeah, that's right.
Fantastic examples of examining how risk affects how people behave in these different markets. But I think the reason that she's really interesting, and she's interesting in general anyway, but specific to our audience and this podcast, is that she's done a ton of work in retirement finance. So yes, risk in general, she can speak to that, but risk in retirement finance specifically.
I thought about her discussion around advisors managing the systematic risk of investing, because idiosyncratic risk is easy to eliminate. I thought that was really interesting, and the value add from working with someone properly.
Yeah, it was a really good way to frame it.
So anyways, Allison is an economist. She's the senior fellow at the Manhattan Institute. She's also a journalist at Quartz, which is a digital magazine, which I'd never heard of before, but I've subscribed, and her articles are golden. So I don't know a lot about the rest of the magazine yet, but I did subscribe. She's a co-founder of Life Cycle Partners, LLC, which is a risk advisory firm.
She's led retirement product innovation at Dimensional Fund Advisors, which interesting connection.
Yeah, very cool. She used to work extensively with Nobel laureate Bob Merton. And so she's consulted to organizations such as the OECD and the IMF. She's been a regular contributor to The Economist, Reuters, as well as Bloomberg Business Week.
Her connection to the Dimensional had nothing to do with her coming on the podcast. She asked us at the end, not if we knew Dimensional, but if we use Dimensional's products. Oh, yeah, we do.
No, it came from, I saw her speak at a conference, and I just reached out to her afterwards, and she agreed to come on and join us. So there's no connection at all. Undergrad of University of Edinburgh, and has a PhD in economics from Columbia. And she's also an adjunct professor at NYU, so she has lots of credibility in this space.
If we're going to talk to anybody about risk in retirement and retirement finance, she's the one to talk to.
So with that, we hope you enjoy our conversation with Allison Schrager. Allison Schrager, welcome to the Rational Reminder Podcast.
Thanks for having me.
I'm super excited to have this conversation after seeing you present last fall at a conference that I was at, and I thought your presentation was excellent. So off the top, my question for you is, how do you describe risk?
Well, I said the technical definition of risk, certainly in finance, is like a probability distribution. Anytime you make a decision and you don't know what the future holds, which is pretty much all the time, it's the whole range of things that could happen, both good and bad, and how probable each of them are.
I think risk gets characterized as a bad thing. Is risk bad?
No, I mean, we do say that. And I said the origins of the word are certainly like something dangerous. And I mean, naturally, we're going to focus on downside because we tend to be risk averse. But technically, risk is good things too. You don't get anything good out of life without taking a risk. Certainly, you know that in finance, you get a higher return if you invest and risk your assets, or you hope you do, or that's why you would invest in them. So it's both the good and the bad, even if we tend to focus more on the bad. And when we say something is risky, you usually refer to something that's going to be a bad outcome.
And because it comes from the title of your book, and your book, by the way, I thought was terrific.
Oh, thank you.
And you spent a lot of time studying risk. Can you talk about what you learned in studying risk in a fringe market like sex work?
Well, you know, on one hand, you learn that it's really all the same, that markets have a way of pricing risk that's fairly uniform. But on the other hand, when you go into these fringe markets, you tend to see subtleties that you don't always see elsewhere. Certainly with sex work, one thing that I think is probably the hardest concept to grasp in finance that I see people gloss over a lot, and I still struggle with it anyway, you know, I've been educated on it a lot, is what does risk-free mean? And what is the meaning of risk-free? Because it's not always the same. It depends on the problem you're solving. And I think we also forget that risk-free comes at a price. But this was like really apparent in a brothel. Because first of all, you realize people are paying a lot for it's effectively a risk-free sex transaction. And also even that the service that has the highest premium on it is something called the girlfriend experience, which is this illusion of intimacy without any risk of rejection. And as I said, you pay more for risk-free, but what is risk-free to people isn't always what you'd anticipate. I didn't expect I'd go to a brothel and be like, wow, there's a risk-free transaction all around me. For some people, I wouldn't call it risk-free, but for a lot of people it is. And I think it shows, one, how fundamental risk-free is to price, and two, how risk-free isn't the same for everyone.
Do you think people understand the risks that they're taking in general?
Sometimes. I think people are better at risks than they get credit for. It's really popular to say that we're these doomed, flawed creatures who can't make sense of risk. But certainly something I saw in my research is that people, no matter what their education is, take risks repeatedly in the same area, tend to be very good at it, very competent, very thoughtful. It's just people tend to be bad at taking risks when information is presented to them strangely, or it's a problem they've never solved before. It's like investing for retirement, which is actually a very hard risk problem. You said multiple Nobel Prize winners are working on this and they don't have the answer. Yet we sort of throw this problem on everyday people with no training whatsoever. And then if they're not great at it, we assume they're the ones coming up short.
In your answer there, you talked about when presented strangely. Like, we are in a risk management business, you could argue. How investors are presented with risk certainly leads to different amounts of risk being taken on. Can you talk about how important how the risk is presented is to the ultimate outcome or decision by the investor?
Yeah, and there's two different schools of thought on this. Certainly there's the sort of behavioralist school that says that we're somehow flawed, that if we see, say, a probability versus natural frequency, so a probability would be like 50%, natural frequency would be like 50 times out of 100, we might make a different decision. But there's another school of psychologists who think, well, we just evolved to think of risk or to assess risk in one way. We came up with probabilities fairly later, much later, and our brains just haven't caught up. But that doesn't mean that we can't be trained in the same way we're trained in how to read. But yeah, you do see a lot of very differences in behavior. In fact, when you see natural frequencies, people actually behave more like economists predict they should. So that speaks to the fact there's a lot of room to manipulate people. And two, it also says that we need to think more carefully about how we communicate risk, because people actually make very good decisions if they really can understand and internalize what risk means.
I think something that stems from that question is people understanding why they're taking risk in the first place, which I know I already asked about. But how important do you think it is to know what your intended outcome is before you take some risk?
Incredibly important. I think, in fact, of all the risk management techniques that I have ever studied, and some of them are quite complex, fancy derivatives and whatnot, I think being clear on what your goals are and what you're taking a risk for is the single most effective risk strategy. For instance, with retirement, we tend to have people focus on wealth, like say have a magic number, like $1 million by the time you retire. But that doesn't really help you with the riskiest part of retirement, which is knowing how much to spend each year. But if you think about your retirement savings, your retirement goals in terms of income, you'd be solving a very different risk problem. You'd probably even have a very different investment strategy. So you might think that all right, I have that $1 million, I've locked it in, I've completely taken risk off the table for retirement. But in terms of making that money last a lifetime, you really are actually very much exposed.
So let me give you a real scenario on that example. Let's assume that you have stock options and you reached your goal monetarily for the income you want for the rest of your life a year ago. And since then, you did not sell, but the options have doubled in value. So now you have an even greater lifestyle locked in for the rest of your life, and you might be in your mid-30s. How would you advise someone to think about the risk in that decision? Because next year it could be double again, or it could be half again.
Well, that's the thing. You could think of it this way. You're always giving up upside. So it's a hedge, right? To sort of take the risk off the table. But you're always giving up upside when that happens. So I think that's why it's important to have a goal. The odds of meeting your goal are much, much higher if you take risk off the table once you meet it, because there's always a chance the market will turn. You could get lucky this year, you could get unlucky the next year. But you have to be comfortable with giving up that extra upside, which is, again, why it's important to have a goal and just be comfortable with reaching your goal.
On the concept of upside, Cameron was talking about stock option on like an individual security position versus selling and diversifying. How do you think investors should be thinking about that difference between, when we're thinking about upside, the potential upside, how should they be thinking about that difference between systematic and idiosyncratic risk?
Well, I said there are two very different sources of risk that have two very different strategies. Certainly, my theory is, especially again with financial planners, is that there's no real benefit into using a financial planner if you're concerned about idiosyncratic risk. It's super easy to buy an index fund and get rid of all your idiosyncratic risk. But systematic risk is a lot harder. And that's what takes expertise. And that's what takes actual risk management skill. And that's where I feel like advisors have a lot of value add. I see this a lot in media of saying, oh, you can just buy an index fund. Why pay for advice? Well, it's because they've only identified idiosyncratic risk. They haven't thought about systematic risk, which is where risk and management options, all these things come in.
Yeah.
Can you talk about the value adds you see that advisors can give around systematic risk?
Well, as I said, like you were talking about an option strategy, or it could just be helping you set your goals and then de-risking. It could, honestly, I think a lot of value add for advisors comes from just honestly sitting down with people and helping them think through their goals, identifying sort of potential risks, certainly when it comes to retirement, thinking about risks like being incapacitated, how, estate planning, all of these things. But I said, it's a fool's errand to think an advisor is going to beat the market. I think that's where a lot of people go wrong, is expecting their advisor is going to get them extraordinary returns. Instead, I said this value add is systematic risk, because if the stock market completely craps out, having an index fund doesn't do you much good, but having a really solid risk management strategy and having someone to talk to is really what's invaluable.
If we assume someone has identified their goals and they put a plan in place to try and achieve them, how do you think people should go about staying true to those objectives, the original objectives that they set, that define the types of risks they decided to take? How should they stay true to those objectives when we are bombarded with so many external influences?
Well, as I said, it's tempting, especially when you've reached your goal, you've locked it in, and your neighbor's stock portfolio went up. I mean, I think this is, again, why advisors play an important role to say, hey, you've reached your goal. If you're comfortable risking some, maybe we'll set a new goal. Maybe we'll take more risk that comes with setting a new goal. And I think that requires a conversation with an expert, because you could also say, hey, if you are comfortable with this and you're complaining about your neighbor getting a higher return because he's still in markets, you have to also understand he's going to lose a lot of that if the market changes tomorrow, and we don't know if it will.
Right.
So I read your excellent article in Quartz on the looming retirement crisis. Given that as a backdrop, do you think it's realistic that most people can reach their own retirement goals without taking on any risk at all?
Probably not. Certainly not where interest rates are right now. I mean, you can if you want to save a ton. But I think most people, it's not worth the sort of huge drop in their current lifestyle to save that much. And nor is it probably efficient or optimal to do that.
Stemming off of that, you've done some work on retirement finance with Robert C. Merton, who's a Nobel Prize winner. Can you just talk a little bit about the work that you've done or are doing with him?
Yeah, we haven't worked together in a couple of years now, but initially we worked together at a startup where we were developing investment strategies for 401k plans that managed everyone's 401k as if it was a little mini defined benefit plan. And this really changed how I saw finance, because I'd worked in the retirement space before, not in industry, but in academia. And it was really Bob who helped me really reframe the problem as an income problem rather than a wealth problem, which is where a lot of people get it wrong. And this just speaks to the way Bob thinks about everything, which is, how do you define risk-free? The first step in any sort of time you're following a risk problem is, what are your goals and what is the risk-free asset? And that is, he says, your numeraire, because, smart guy. But for the rest of us, that would just be like, what terms do you put your goals? We did that for a while. And then eventually we were acquired by DFA. And so we continued to develop the model there and eventually developed a post-retirement income strategy.
So what does that risk-free mean to an individual planning for their retirement? Can you elaborate on that a bit?
Well, I mean, I guess technically it would be an annuity price or a laddered bond portfolio that would give you a stable income for a certain amount of years, or in an annuity case, it would be your entire lifetime. Annuity might not be right for everyone, but it does sort of give you a risk-free price on retirement income. This is important because it has a much longer duration than like a T-bill. And your average target date fund defines risk-free as a T-bill. So really, it's misspecifying the problem. And this is leading, I think, most American households to be short duration in their retirement portfolio.
Can you just touch on what, I didn't realize that the startup had been acquired by Dimensional, which is interesting. What is that post-retirement product doing that's different from just a regular target date fund or a long-only portfolio?
Well, it would be, as I said, I think they've abandoned it in the last couple of years. I've been working on it since on my own. It's just, as I said, in a strategy that is effectively kind of like a laddered bond portfolio, but it's a lot cheaper because we just do duration matching with bond funds.
Interesting.
So what it actually does is you put out an income goal, and it could actually, as I said, simulate a laddered bond portfolio, only doing duration matching. And as well, there's also scope to be in a riskier portfolio and not just be all in bonds, because with rates being what they are, a lot of people can't afford to even be risk-free. Even after they retire, they have to take some risk.
Fascinating. So it's like a liability matching product that people can use. Is that the idea?
Yeah, I mean, and the core of what we did pre and post retirement is that, assuming they were well funded, which they very rarely were, defined benefit plans kind of did have at least the asset strategy right. They were income focused. Why have we made 401ks so wealth focused instead of just taking what we know work for defined benefit plans?
Yeah, that is really interesting.
Some of the numbers in your retirement crisis article were absolutely staggering, like $400 trillion shortfall estimated by 2050. Like this is way beyond the value of like the entire stock market, for example. How do you frame this issue and how severe is it?
Well, I don't think it's quite as severe. I mean, I throw out that number, but I think there's a World Economic Forum number. And then they also are assuming everyone retires at 65 with a 70% replacement rate. And you know what? That's like probably just not going to happen for most people. First of all, there's a lot of controversy about whether a 70% replacement rate is appropriate. It's probably even less realistic that a lot of people are going to retire at 65. Most people are probably going to have to work at least part-time into their 70s. So that certainly makes it a little bit less bad. And as bad as it all looks, we have to remember that people actually the average household is going into retirement with more wealth than ever before. And that's in part because of 401ks and the takeoff of 401k type plans. Everyone sort of gives them a lot of flack because they don't think they're as good as defined benefit plans, but they have much wider coverage. About 50% of people have access to a workplace retirement account. Only 30-something% did at the peak of DB plans. So in part because they're cheaper, they're also more widely available, which overall has increased retirement savings.
Makes sense.
So it's not all doom and gloom.
It's not, but there's still problems. There's a retirement crisis school, and then there's the nothing to see here school. I'm probably somewhere in the middle of, I think, it's not as bad as people think. In some ways, people have more wealth than ever before. But there's still huge shortcomings in this market. For instance, we don't have a good post-retirement option. I mean, I think a lot of people and policymakers are relying on annuities, and I'm skeptical that a market will ever really take off. And also, the long-term care market is very scary. It's really hard for insurance companies to offer reasonably priced long-term care insurance, which is why a lot of them are not offering it. And that's leaving people exposed to a huge source of risk. Certainly, their entire families are exposed to that risk, because often children or spouses end up being caregivers.
What makes you skeptical that the annuity market will take off?
People don't like annuities. I love annuities. I'm a retirement economist. No one else does. I think people are skeptical or just sort of scared to take their life savings and hand it over to an insurance company, even if it means they're reducing risk, even if it means they get more money because they're pooling longevity risk with other people. And I think that is in part because of fears about long-term care expenses. And also just the scariness of having a big financial firm have all your money.
Makes me think of another question when we talk about people not wanting to buy annuities and maybe not understanding the risk they're taking by not doing so, do you think that, and actually another example is maybe people thinking that stocks are risky even for a long-term goal and bonds are safe, even though it probably isn't true. Do you think people are good at thinking about how to measure risk?
Again, if they're experts in it, no, they're very good at it. If they're not, they're not. But the thing is, it doesn't help that when it comes to the retirement problem or personal finance, we complain people are terrible at it, but we also give them a lot of really mixed messages. This is it. Think of some financial company focusing on what is your magic number? What is the amount of number you need to have when you retire? Well, that sets people up for failure because it gets them thinking about the day they retire, but not anything afterward. What afterward is the hard part. It also would make them more skeptical to annuitize because you're like, I work so hard, I have all this wealth, and now when you're going to hand it over to an insurance company. So, to some extent, yeah, people are bad at measuring risk and understanding the risks in retirement, but they also get a lot of really mixed messages that I think are leading them astray.
And there's also a lot of bad behavior too that goes on.
Oh yeah, for sure.
And would you have any recommendations for people as to how they might be able to behave better and behave more rationally?
Well, I think a lot of it is tuning it out, put money in your 401k and just don't look at it. I personally, my various 401ks over the years have no idea how much money is in them. I do roughly have a ballpark figure because, that way I don't sweat what happens to the stock market with it because I'm in it for the long term. And also I'm not looking at it and thinking if I want to buy something, this is money I have available to me. It's sort of it's just there and I don't think about it. So I think you just kind of have to try to tune it out. Now, a lot of people don't have that option. It's their only form of saving, which is another issue people have in personal finance. But if you can, I think what you want to do is put as much money as you feel you can into your retirement savings and then just don't look at it.
We've been talking a lot about risk, which we can measure and quantify to an extent and maybe plan around. What about uncertainty?
Mm-hmm. Well, that's the other one. Risk, as I said, what can be measured, uncertainty is what can. And, In my book, I talk about the surfers who have all of this, and we certainly see this in finance too, fancy risk mitigation technology, just like we do in finance. Like their tools are a lot like stock options in a lot of ways. But the fact is, no matter how good your risk management strategy is, you're still in an 80-foot wave. And there's no way that's going to be safe. And I think the same is true of investing in markets. There's no way you're going to get a higher return than the risk-free rate and you can have a risk-free experience. Like there's always risk involved. I think that was the lesson I took away from Bob Merton's experience in LTCM. It's like, yeah, they had a lot of stuff going on, but you know what? They had a 21-to-1 leverage ratio. And nothing in the world is ever going to make that safe. So I think that's where uncertainty comes in, because you're in the water and something's always going to come upon that you just can't anticipate. And I think the only way to really deal with that is liquidity. But liquidity is expensive, obviously. It's keeping money on the sidelines. So you have to think about how much liquidity do you need? And again, that's a hard thing, but that's the only real hedge against uncertainty.
Did Bob talk a lot about LTCM?
Yeah, he likes to talk about it, but usually the stories are actually more fun, like the good times they had. It was actually fun. I went to his fest shift, which is his 75th birthday party honoring his work, and a lot of LTCM people were there. And someone now from there makes a wine called Convexity Wines. So I was given this bottle of wine called Convexity Wine, which I was pretty excited about. So we're all fixed income geeks.
Yeah.
In a recent podcast, I thought you gave a really interesting framing about the risk we take on when we make a house purchase. Can you talk about that, especially since we have so many listeners that live in really hot real estate markets?
Yeah, for sure. I mean, housing is always sort of a fraught purchase, I think, because it is both what people live in and people like to see it as an investment. But it's fascinating to me. I have a friend who bought an apartment in New York, and I was having dinner with her. It was around the time I was writing the book. And everyone was just like, well, of course you got to buy this apartment. It's always a good investment to buy an apartment in New York. And like, as a financial person, like there's no always good investment. Obviously, it depends on what you're paying. But people tend to assume prices can only go up. But obviously, we learned in the financial crisis, one, that's not true. And two, you face different sources of risk with a house. There could be an idiosyncratic risk. It could just be like a really cool house with cool features or something trendy. Or, as I said, there's also this larger systematic risk if the whole market could collapse. And I think when you're buying a house, you have to be aware of each, especially if it's idiosyncratic. If something quirky about that house, you can always recreate that elsewhere.
Do you have thoughts from an economist perspective on the rent versus buy discussion?
It depends. It depends what you're paying. I personally have never owned a house, and I have no mixed feelings about that. I don't feel like I'm 42, and I don't feel like I'm a personal failure. Although if I read stories in The Atlantic, I was told I am, that I haven't achieved this major mark of adulthood. Anyway, I'm like middle-aged. But I think homeownership personally is overrated, but it makes sense for some people. It really just depends on, one, what you're paying, two, what the rental market is. I live in New York, so there's a very vigorous rental market. And three, what your lifestyle is and what your liquidity needs are. But I find it odd that people are so fixated on millennials not owning homes but having student debt. Because as a life cycle economist, I look at student debt as an investment in your long-term earnings. It not only does it mean you get higher earnings when you finish college, because sometimes you don't, it places you on a higher, steeper wage path throughout your lifetime, and also reduces the risk of unemployment, which is a significant investment that pays off over 30 years. And why people think home ownership is a better investment than an education is sort of baffling to me.
Do you have any thoughts on, because you mentioned life cycle investing, there was a paper from Ian Ayres and Barry Nalibuff a few years ago where they recommended using leverage to get to your lifetime equity exposure as soon as possible. Do you have any thoughts on young people using leverage to invest?
So I'm not familiar with this paper. Is the idea that as a young person, you have a lot of human capital ahead of you that's bond-like?
Yeah.
And that's why you should take leverage, because it's negative bonds to get you earlier?
It's effectively that. And the reason being to gain time diversification across time with your equities.
Well, I partially agree with that. I agree that, I'm not going to go out and tell everyone to take leverage because it's very risky. But in theory, yes, there's an optimal debt equity split, and young people having almost all their assets in their future earnings, which are bond-like, are probably overexposed to bonds. Whether or not they should take on leverage and all the risks associated with that, I'd be wary to go there. But in theory, yes. But I do part ways with them on the whole time diversification issue, because I believe that's a fallacy. Yeah, like on average, over time, you have a lower volatility, but you also have a much bigger tail risk, right? There's no reason why we couldn't have 40 years of really bad stock market returns, and you're taking on that risk. So there is, I said, a fallacy of time diversification there. But in theory, yeah. I mean, if you have the average young person, even if they have almost no savings, is totally overexposed to bonds.
Interesting.
So do you think most investors should have an allocation to bonds?
I mean, I guess in theory, if you're a young person and you already have all your earnings in front of you, no. But it also depends on your individual risk tolerance. I don't think anyone's risk tolerance is necessarily wrong. It just depends on you and what risks you're comfortable taking. Even if you are a young person, you've got years of your earnings ahead of you. So in theory, you've got a ton of bonds in your portfolio. If you're just someone who cannot handle losing a cent of money, and that's just you and you're 25, then maybe you should be mostly in bonds.
What about the other extreme where your retirement is like you're wealthy and you have way more money than you will ever need? What do you think about the argument that a person like that should be all in equities?
All in equities?
Mm-hmm.
Well, I mean, again, if they're comfortable with that, but as I said, that does seem a little risky to me, but it depends on that person and what their goals are, and certainly how they plan to use that money in the future, and if they plan to leave it to their heirs and what their heirs' needs are. Again, I think this is the big challenge for personal finance, is that, people's needs, especially after they retire, are so idiosyncratic, and there's so many people who don't get the advice they need.
It's tricky too. We can tie it back to we were talking about where people that give financial advice can add value, and we were talking about the framing of risk. I think we end up seeing a lot of young people who have a lot of bonds in their portfolio because they think that's safe, and they think that's that's the right way to be risk averse when you're young. But I don't know if that's always necessarily true. It's probably not.
Yeah, well, also depends on the duration of those bonds.
Right. That's very true.
And also, I'm seeing more and more, I see this in a lot of financial firms, that because the risk-free rate has gotten so low, they keep pushing fixed income assets with a lot of risk associated with them as risk-free. Or not, they don't say they're risk-free, but they're like, oh, this should be like in this breakdown of 60-40. Everyone's like, oh, you should have high yield debt or REITs in your 40% fixed income portfolio. Well, it's like, yeah, it's fixed income, but that 60-40 split was supposed to be risky, non-risky,
right?
Not just risky fixed income. So I think people are also being misled about fixed income being risk-free when a lot of it is very risky.
I've got to ask, since you brought it up, is the 60-40 portfolio dead?
Well, I mean, I never sure I believed in it to begin with. I mean, the idea that there's one portfolio for everyone, but the extent, if you believe that risky, non-risky should be 60% risky, 40% risk-free, and you have a good reason for that, then no. I mean, that shouldn't change with what happens to markets. You might need to reassess, can I afford to do this anymore? 60-40, just a luxury I can't afford. But if you really believe that this is the right split between risky and no risk, then, that shouldn't change.
We often hear that, well, stocks are so overvalued, you can't buy stocks now. And then bonds, bonds are so overvalued, you can't buy bonds anymore. So there's so many articles that we've talked about on the podcast over the past 2 years that suggest that 60-40 is dead. Therefore, you need us as advisors to go out and find you alpha products or hedge funds or liquid alts or whatever it is.
Yeah, and I see those too. And it's like all they're doing is putting you in other risky assets.
Correct.
There's no free lunch here. I wouldn't say there's anything. I mean, I don't know. I'm not an active market person, but if there's anything that's really undervalued, you maybe can get a higher return going in something more exotic, but you're also taking on more risk, and there's really no way around that.
And not only not a free lunch, there's often higher fees involved with those products.
Yeah, for sure. But I guess that's how they justify the fee is that I saw a presentation where they were like, these are all the things we think you should be in your 40% portfolio. And I was like, what's the vol on this? And they're like 20%. I'm like, then what's it doing in the 40% portfolio?
Interesting. Another question I had for you. One of your articles talked about how much private equity is being added to portfolios like pension funds and things like that. Any comment on that?
Well, I mean, again, when the risk-free rate is low, people need to find risk elsewhere. And I think private equity is very attractive, certainly for pension funds, because they have a certain rate of return they have to claim they're getting each year. And private equity, no one really knows what this stuff is worth. If you look at the financial reports from pension funds from year to year, they always say our private equity fund returns, like 16%. And every year it's the exact same, because who knows what that number means. If you have something illiquid that's hard to value, it sort of makes a pension fund, it's very attractive for them to I think Cliff Asness calls this the illiquidity premium, that you have something and you can sort of claim whatever, I don't know if he defines it this way, but this is my understanding of it, that you can just sort of claim whatever return you want, which if you're a pension fund, or certainly a lot of institutional investors who don't need their money immediately, but do have to prove that they're out earning the market, can be very attractive. But you're also taking on a tremendous amount of risk because none of this is going to be realized for years and no one knows what this stuff is really worth.
And it's certainly gone mainstream this week with Vanguard announcing a product in the private equity space.
Yeah. I mean, I feel like it's one of those things, we go from, all these bad actors doing all these fancy things, stay away, to, gee, we need to let the little guy in on this.
It is interesting. The whole private equity thing is fascinating because you've got the smoothing of returns too, like you're talking about, which makes it look compelling on paper to, for example, a pension manager to add in.
Which is worrying in of itself because it leaves taxpayers exposed. But the idea is, well, that we're going to open this up to everyday retail investors. Said is a little scary. And if this all goes bad, what the narrative is going to be, which is everyone got duped into this. And I mean, I'm not even against private equity. I think it could be a very valuable asset class. And there's a lot of evidence that it actually can make markets more efficient. But, you can have too much of a good thing.
You wrote an article recently that I read about the global shortage of safe assets and how that might have an economic impact. Can you talk a little bit about that?
Well, yeah, this is it, because the foundation of everything is risk-free. And I mean, shortage, is an odd term because on the one hand, as I said, there's this huge demand for safe assets, but only a couple countries can produce them, which creates a natural shortage that there's really no way around. And it's made the cost of low risk very low, historically low. I don't think we really know what the consequences of that are going to be. I mean, on the one hand, I'm hesitant to call it a bubble. One, because I don't believe in bubbles. And two, because it's like, a bubble, I guess, if you believe in them, it's an asset that speculators have driven up to the point where it's overvalued and it's going to pop. And that doesn't really make sense for low risk bonds. Foreign investors might lose their appetite for them. The government regulations might change where institutions stop buying them. So prices would fall eventually. But I don't see it being like a one day it just crashes like the tech bubble. On the other hand, it's the systemic, it's so important because it's everywhere. Think about the risk-free rates in almost every asset pricing formula. It's everywhere. So if interest rates, it certainly is driving how much leverage are on a lot of corporate balance sheets. So if you think about it, if there is a big change in the bond market, it could cause a lot of dislocations.
How did you become so interested in risk?
Bob, I always had an interest. Obviously, I studied retirement finance as an economist, so that is a risk problem. I never realized that was central to it. But, I think Bob is such an exciting, inspiring thinker and he's just so passionate about risk and being risk at the center of it all. I think anyone who'd spend as much time with him as I did would walk away kind of obsessed with it.
If we think about this, the concept of the global retirement shortfall, what do you think, if anything, what do you think people could be doing differently now, pre-retirees, to address that for themselves?
Mm-hmm. Well, I think it's working hopefully with a good planner, setting very clear goals and having a plan for post-retirement, having a plan for long-term care. And as I said, being realistic about the risks involved and what it costs to reach your goals. Like my own mother, she has a DFA advisor who I have a lot of faith in, so I don't like to get involved with her finances. But yeah, I mean, she's very obsessed with having this certain number of when she retires, but it hasn't really as well thought through exactly what her plans are for retirement.
My last question for you, Allison, and it's always my last question. Can you define success in your life?
Well, I think it's different for everyone. I mean, for some people, it's their family. For other people, it's having a certain amount of money. For me, I think it's being really intellectually fulfilled and meeting new people and finding new ideas every day.
And it appears that risk is giving you endless opportunities to explore.
It's a great topic.
So, Allison, this has been great. So happy you could join us. This has been an incredible interview, and I think you've added a ton of value. So thanks for your time.
Thanks for having me. It was fun.